Good afternoon, everybody. Welcome to the Business Broadcast. And it is a beautiful day outside my window. So I am certainly looking forward to the weekend. Today, I have got the lovely Richard Feakins with me. Good morning. Good afternoon, Richard.
Good afternoon, Nikki.
It is afternoon where you are as well.
Yes, it's an hour ahead of you.
Oh, even more mid-afternoon, siesta time. Super. So Richard has joined me before, so some of you will already recognise him. He is a super brilliant tax guru, and my team and my clients are always talking to Richard about to get top tips for whether it's people selling their business, restructuring their business, all sorts of different things tax related, because he is brilliant. So today we're continuing a bit with the theme. For those of you that watched our roundtable a couple months ago, I think it was now, where there was 5 of us, and Richard was, when we did the bumper edition, the whole hour edition, we were talking about all things selling your business. Richard, there was just only time for a snippet last time, so today we're getting a full fat 30 minutes so that we can go through the top things for you to do, so that when you do sell your business, you can try and ensure that you keep as much of that money as possible yourself. And we've got lots of really great tips that Richard is going to go through and take you through the process of the things that you need to think about. Just a couple housekeeping things. As always, we are live on YouTube and on LinkedIn, so please do post your questions in the comments section as soon as you can, or even just say hello, or even just do let us know what flowers trap butterflies, because we were talking earlier and we couldn't think. We know lots, but the one that Richard was thinking of, we couldn't think of. So, so if you want to think about tax, let us know which flowers can attract butterflies, and we'll see if at the end, if we can try and remember what Richard was actually thinking of. But anyway, so without a further ado, because we have got so much to pack in, we are going to crack on. So, Richard, so the first thing that we need to be thinking about is, what are we actually selling? So take us through, why do we need to be thinking about what we're selling? Shouldn't we already know that?
Well, it does sound very obvious. I guess the starting point is that most people, or a lot of people, are aware of something called entrepreneur's relief. It's now got the new snappy title of business asset disposal relief. Broadly, what it means is that if you're selling the right thing, you can pay as little as 10% tax when you sell it on the gain. So we need to work out, first of all, what it is we're actually selling. And that sounds really obvious. And in a lot of cases, it can be. You might just be selling the shares in your own company. You're the 100% shareholder, and you think, great, that's nice and straightforward. But that's not always the case, especially with entrepreneurial, perhaps owner-managed businesses. It can get a little bit messy, so that, for example, one of the conditions for the relief is that you've owned the shares for 2 years, at least 2 years. If you haven't, you're not going to get that relief. The company may own a substantial investment portfolio, for example. If that's the case, it again may not get the relief. So we need to think, we need to actually establish what's being sold. Another great example is that if you're selling a business as a sole trader, or perhaps as a partnership, you might be selling off some of the assets of the partnership. Now, you can get the relief if you sell whole or part of a business. Assets of the business aren't the business necessarily. So, for example, you might be a legal partnership owning the office that you operate from, and decide, right, we're going to sell the office and we're going to all work from home, and we're going to get entrepreneurs relief, business asset disposal relief on the sale of the office. You're not, because you haven't sold the whole or part of the business. You've just sold one of the assets. The business carries on. You can still carry on doing exactly the same thing. It hasn't changed the nature of the business at all. So we do need to establish what makes up what's being sold.
And currently the difference, what we're talking about at the moment, is the difference between 20% and 10%. That's correct? Yes.
Absolutely. And
So,
just remembering,
it's double. So it's
yeah,
critical to get the right one.
just remembering there is a £1 million lifetime limit for business asset disposal relief. So gains of up to, not proceeds, but capital gains of up to 1 million can be sheltered by business asset disposal relief.
Yeah, no, so that's important. So yeah, you want to use that, because that's potentially saving you. So on a million, what they're saving you is 100,000. Right. 100,000.
Sorry, I use that example all the time.
I know, but I've never actually thought about it, to be honest. Yes, so that's it's a good relief to get £100,000 in your bank account instead of the government. So okay, so that's the assets, being clear what's in there. Just before we go into our next section, I'm seeing a lot more people put into their business investment assets, and I'm not talking about properties, because to be fair, most people that I see put their office or their factory or whatever in a separate entity. So they do it as an SPV, so it's quite clean. So because often when they want to sell, they actually want to keep that and have rental income from it. So they keep it separate. But what I am seeing is some people seem to have still managed to get some businesses have still managed to get a lot of surplus cash and are looking at more innovative ways, because the interest rate's been so low, until now, it's starting to go up, have been starting to be a bit more creative for what they're investing in. So just let's go through a couple examples that I've seen. So for example, where I've seen them put money into what they would call, I think it was like corporate funds, put 100k into a corporate fund instead of keeping it in their deposit account. How that would be exempt.
How
You'd
would
have
that
to take that out? Yeah.
So the broad rule of thumb, the accepted rule of thumb, is that if more than 25% of the activities of, let's say, the company amount to investment, then you're not going to get the 10% rate. So cash held for working capital is fine. If historically you've held cash as working capital, that's absolutely fine. That's accepted. If you haven't historically held and you've got a quantity of cash which you've just realized from profits and you're accumulating that cash, then you've just kind of got to demonstrate that it's for perhaps future expansion plans. So you might want to put a board minute in place, something like that. The other thing to bear in mind is that cash held on deposit is different to cash invested.
Yeah.
So once you switch out from cash held in the business bank account to a product, it could be a portfolio of shares, it could be an investment bond, something like that. You're not going to be able to persuade anybody that is held for future expansion plans. It's not ready cash. So if that starts to look to creep over 25% of the activities of the business taken in the round, then you're going to possibly struggle with the 10% rate.
So the other thing that I've seen a lot of people start to put in their companies, who, though over recent events they may have regretted that fact, is put money into cryptocurrency. So so that would be treated differently as well, not like cash.
Absolutely. The rule of thumb at the moment is that crypto is not cash. It is held for investment purposes.
Yeah.
That there's real pushback from HMRC at the moment where anybody tries to argue that it's a trade, for example.
Yeah.
The presumption is that crypto is held for investment.
Indeed. Okay. And yeah, although we can't recommend, we're not investment advisors, so we can't recommend whether or not to invest.
No, the
Right.
last month has been carnage.
Yeah. So this has happened. Who knows? Anyway, so our next area, really
Yes.
important to think about, which, you know, especially if somebody set their business up quite a long time ago, may not even remember quite how it was structured. So what are the different, why wouldn't they know how the business was structured, or what's the importance of that?
Well, again, one of the or let's go through the conditions for the disposal relief to apply in
Okay.
respect of a company. Okay, let's keep it. I mean, that is the most common scenario. You must hold 5% at least of the shares.
Okay.
You must hold them for 2 years.
Unless under
At least.
EMI share options, isn't it?
Yes, but that's outside the scope of this
Yeah.
conversation.
No. Yeah.
I can ramble on for
No. I know we could be talking days, days and days on this exciting topic. Yeah.
So yeah,
Sorry.
I mean, broadly, 2-year holding period,
2
a
years.
trading company, and 5% holding.
Okay.
I came across a situation perhaps a couple of years ago now where an individual set up a company. Shortly after, he brought somebody into the business who was valuable and said, right, you can have 10%. Many years later, the business was sold. We discovered at that time that this individual never had any shares at all.
So it never got set up properly.
It was a promise to pay 10% of the proceeds on sale.
Oh dear.
Now, if he'd held 10% of the shares, he would have paid 10% on the capital gain. As an employee of the company, he paid close to 50% tax on the 10% of the gain because it was treated as employment income. So it's really important to understand what the structure is, make sure all the paperwork's in place.
Make sure you've got your share certificate so you can know that you've got it.
Absolutely. It's actually not the first time I've seen that. Usually with smaller amounts, not 10%, but I've certainly seen quite a number hovering around the 5% mark. The other situation I came across recently was where somebody held 4.97%.
Oh.
And with a bit of a tweak a couple of years ago, it could have all been quite different.
That's a shame. And you see, because also so many times people share, the owners think about, oh, I'm going to give 5% here, but they've got to be careful how they do it, isn't it? Because it's all right if they do 5% and make sure that is 5%, but if you give 5% away and then give another 5% away and you don't do it in the right way, that first 5% is already watered down, isn't it?
That's right. It's all diluted already.
So that's why I always like to look at how many actual shares. You can always look at the shares divided by the total shares to get the true percentage.
Absolutely. Absolutely. People do very much think in terms of percentages at the time that they acquire the shares, and forget about the future. The other key area to look at is where you have husband and wife arrangements. Quite often, the company is set up was perhaps by the wife, and the time comes to sell, and she holds 100% of the shares, selling for 2 million, let's say. She has a lifetime allowance of 1 million for the business asset disposal relief, so she'll pay 10% on the million, 20% on the second million.
So this is a reminder that I do need to give Alex some shares. Okay.
It's a reminder that if you have a great spousal relationship, perhaps split the shareholding.
Yes. Yeah. That, and you know, that's often what people say when I because often I'm at the start of the journey with clients besides on the exit, and they're saying, oh, well, you know, everyone's saying, oh, I want to do 50-50 now. I do usually say to them, absolutely, if you're treating your money all as one big family pot, but do think about, as long as you're not thinking about splitting soon. And it's a horrible conversation, but you have got to think about it, because if you haven't said that and then they are splitting, and it, you know, you've got to, because if you give it away, you know, you can't just say, well, I'm having it back. You know,
Exactly.
it's their decision to give it back or not.
On the practical issues there, you've got to give them away at least 2 years before the sale.
Yeah.
So there is going to be a 2-year period where either of the spouses might feel a bit nervous, potentially. But they
want to sell the business to be able to get away.
The other takeaway is make sure you've got proper shareholder agreements in place.
Yes, definitely.
To deal with situations where there may be a split, or deal with a situation where one half may want to sell the business and the other half doesn't.
Yeah, that's a very good point.
Uncommon.
What I've seen is where you've got minority shareholders and you haven't had a drag and carry clause, and you've had to have 100% voting unanimous voting to do the sale. Don't do that. Sort out in your shareholding. Make sure that you can do it with a majority, whatever the majority you want to have, whether it's 50% or 51 or 75 or whatever. But do make sure you have those, because otherwise you have sort of situations, you've got some minority shareholder. What if that minority shareholder has now died and it's now looking up the estate, or it's been taken over by all sorts of different issues? So you need to know who are the actual current shareholders. Make sure you've got up-to-date information for them. So make sure you're keeping up your company books, and make sure the main decision makers can make that decision on their own.
The other situation I have come across is where perhaps a business owner has sold part of the business,
right?
Perhaps 95% of their shares, and they're then in a position where they sell the rest of the shares, and they no longer hold 5%.
Yes, and yes, we've come across that, but there are ways to sort that out, isn't there? But absolutely. That's not time to talk through that today, because that would take you a while. So if you're in that situation, you want to do partial exits and still retain those release and things, so you definitely need to contact Richard. Just a reminder as well to put through questions. So guys, if you make sure you always get tax advice before anything. Absolutely, don't make that mistake. Just a comment. Look like a bit of a wine connoisseur.
I'm in wine country.
Yeah, absolutely. Got get in the mode. And then good paperwork. So from the HMRC perspective, absolutely got to have the right paperwork. There's no point having handshake agreements, whatever. You need paperwork to prove these things.
Yeah.
Super. Okay, but we've got another section to go through and top tips at the end. So please do carry on listening. But any questions, we will even if we need to stay over for a couple extra minutes, whatever, to answer any questions that come through. So the next question, and this is actually in some ways the first question that I often ask in some ways, but probably from a slightly different perspective than what you're doing from a tax perspective, is why are you selling? So why is that question really important?
So understanding what you're going to do with the proceeds. So are you selling
Okay.
to retire?
Mm-hmm.
If that is the intention, then presumably you'll end up with a big pot of cash in your pocket, wondering what to do with it. And at that point, I'd strongly suggest taking some inheritance tax advice, because that sum is not going to be insignificant.
40% inheritance tax, people.
Yeah, absolutely,
Big.
absolutely. And it could be as simple as you might just go out and buy an annuity. It could be as simple as that. It could be gifting. It could be trusts. It could be any number of arrangements. Everyone's different. Everybody needs personal inheritance tax advice.
Absolutely. And get it sooner rather than later.
Yeah, sadly, so many people work so hard on their businesses all their lives. I have seen, again, sadly, so many people pass away at a relatively young age, quite soon after retirement.
Yeah.
And that's unfortunate.
Yeah.
Mm.
Indeed. Well, that was a bit of a
On
downer
that
to
note,
end on, but I think we better lift things up a bit before we
yeah,
finish.
yeah, yeah. So I mean, it could be that your motivation is perhaps semi-retirement, or not even that. Just you just want to go out and buy some investments, perhaps some buy-to-lets,
Yeah.
and then use that to fund later retirement. So I mean, many business owners are young, in their 50s, 60s when they sell their businesses, and they've got a long retirement ahead of them, and they see property perhaps as a safe haven for the cash from the sale.
Yeah, I suppose it can go either way, can't it? Some people might, say it's 50 that they do sell their business. It's either way. It's, those ones that do pop off very quickly, but then there's others, they've got to fund their life for the next 40, 50 years. So it's a long time. It could potentially be a long time.
Yeah. So
Pete's just got a little question. In fact,
sure.
Pete, Richard was missing you. He thought that you were going to be in here as well, and he was very disappointed when I said no, it's just me. But Pete does say, so semi-retirement seems to be the most popular goal for most owners I know. Yeah, that's it. You've been working 7 days a week, thinking about the business constantly, to selling. You don't want to. How hard would that be to be working massively hard to doing nothing, having something in between, so still doing some consultancy or angel investment, whatever else, is a good pathway to retirement rather than straight to retirement.
So I'll lump in then the third one, which is perhaps you want to invest in another property, in another business.
Indeed, yeah.
So it could be a semi-retirement where you're investing in perhaps what we would call non-trading assets, so investments like property, buy-to-let property, or it could be that you want to actually go back into a different trading business or try your hand at something different.
Sorry.
Sorry,
I was just going to say, if you're just very quick, because this will take another hour. if you're rolling over, I think that's right, isn't it? Rolling over
Yeah.
your relief and investing, you would still be able to keep that 10% later on to go back to
Yes.
the 10%. Yeah. So
Yes.
so you could potentially even be really saving the cash and not actually paying anything on it yet if you're doing a rollover and investing in another
Yeah.
business.
Yeah. Exactly.
Sorry, I
That's
interrupted your
fine.
point.
Yeah, if you sell your business for £1 million and you invest that £1 million into another business, that capital gain tax is deferred until you sell the second business, or on your death, nothing is payable, which is great.
Sorry, say that one again, Richard. Just so, because that sounded good. Nothing payable on death. So let's just reiterate that point. So how?
So if you sell your existing business for £1 million
Yes.
and you invest that £1 million into another
It's another
business,
business. Yeah.
um,
Business asset.
and
Yeah.
you still own that business at your death, and there'd be no capital gains tax. And in
So
fact, if it's a trading business, there'd be no inheritance tax either.
fantastic. So that's, and you don't have to be actually actively working in that business. You just got to own a share of it.
As long as you own shares,
Is
then
there a
that's absolutely fine.
percentage amount or just shares?
Unlisted shares,
Perfect.
unlisted
Perfect.
shares in a trading business. Yeah.
That was a super top tip to end on there. Just summarising, so it's a few minutes. So just throw in any questions anyone that's got. But so let's just summarise. So we've got 3 top tips here. What are you selling? You need to know what you're selling.
Absolutely.
Hopefully the savvy buyer will double check what they're buying. So hopefully there won't be any problems there. They will be doing due diligence. Knowing how your business structured.
Hmm.
And third, why are you selling and what do you
And what
do with it?
what do you do with it, and how do you manage that? There are loads of stuff we haven't covered. We haven't talked about, for example, a holding company. Your business could be owned by a holding company. If the holding company sells it, there is no capital gains tax payable at that point at all. So if you want to invest into buy-to-let property, for example, that's a great way of maximizing the amount of cash that you've got available to go and buy those properties, because you won't pay 10% tax at that point. There'll be no tax payable if your trading company is owned by a holding company. So that's a good tip.
Super. No, that's a cracking tip. So I think so. We've summarised the 3 tips. What are you selling? The structure, and what are you going to do? Key point, going back to an earlier point from Guy. Make sure you get tax advice before you do anything. You know, as many of you know, I'm working more and more on business exits now. And if you are thinking of exiting, get all this in a row before you even start it. So, especially as, people have to have 2 years of owning these shares and things. So if you are thinking of exiting in 2025, now is the time to start making sure, have you got the structure right? And get hold of Richard, talk it through, and see if anything needs to be changed, altered, restructured, or if you are about to make a sale, so but you want to make sure if there is any last minute things. There's less flexibility if you're doing last minute, but it's never not too late to do something. Get hold of Richard. So Richard is, for everyone that's gone in via LinkedIn, Richard's link is on there. Richard Feakins. It's there's not loads of Richard Feakins on LinkedIn, so you'll be able to find him. And he'll be the one with the lovely tan compared to my vampire-ishness at the moment. And yeah, be able to contact you on LinkedIn or phone into our office, and we'll be able to, if you're one of our clients, we'll be able to organise a joint meeting with your client manager and Richard to get the right advice for you. But that's fantastic. So hopefully we've saved lots of people potentially £100,000 by being able to use their BADR through this half hour, or potentially even more if they were foolish enough to set it up so that they've got phantom shares, not real shares.
Yes.
And we could be saving them from the 50% tax. So this hopefully has been a very worthwhile half hour for everybody. But thank you so much, Richard. And
thank you, Nikki.
And thank you very much for joining us. Have a lovely, lovely weekend. And I'm sure it's even more sunny in your place than my place. I'm trying to think, what are we next week? Next week's a bank holiday. So everybody will be having their bunting out and celebrating the Queen's 70th Jubilee. So have a lovely weekend then. I believe we're doing another tax topic the week after. I think it may be employment status, but I'll have to double check that. But do look on LinkedIn for the advert for that, which will come up in the next few days or so. But thank you so much, Richard. As always, please subscribe to YouTube if you're watching on YouTube. If you're on LinkedIn, please subscribe to our pages as well. But thank you, Richard. Have a lovely weekend.
You too, Nikki. Take care.
Cheerio. Cheerio, everybody. Have a lovely weekend.